Before you buy a single ounce of silver, stop for a moment and ask yourself a question most investors never ask. Are you buying silver because you understand it, or because you are afraid of what might happen if you do not? That difference may seem small, but in markets, small differences in thinking can become very expensive. Silver is one of those assets that attracts people at emotional extremes. When the world feels stable, most investors ignore it. They treat it as old-fashioned, slow, unnecessary, something that belongs to another era. But when inflation rises, when banks begin to look fragile, when governments borrow without restraint, and when headlines begin to sound uncertain, silver suddenly becomes attractive again. And that is precisely when many people make their first mistake. They do not buy silver as part of a calm plan. They buy it as a reaction. They see the price moving. They hear someone say the dollar is in danger. They read about debt, war, central banks, or currency collapse. And before they understand what silver actually is, they rush in with emotion disguised as conviction. Markets are very good at punishing that kind of behavior. Silver is not a simple asset. It is not merely a shiny metal sitting outside the financial system, untouched by the forces that move everything else. Silver is connected to inflation, interest rates, currency movements, industrial demand, futures markets, liquidity, investor psychology, and the hidden machinery of global finance. If you buy it without understanding those forces, you are not protecting yourself. You are stepping into a complex market with a simple idea, and simple ideas can be dangerous when the system around them is complex. The first warning is this: do not confuse tangibility with safety. Yes, silver is real. You can hold it in your hand. It has weight. It has history. It cannot be printed by a central bank, and it does not depend on a government promise in the same way paper currency does. That is why silver has always had a place in serious conversations about wealth preservation. But real does not mean risk-free. A physical asset can still be bought at the wrong time. A good asset can still become a bad decision if the price, the position size, and the purpose are misunderstood. Many investors discover this too late. They buy silver because they believe it is safe, but they never define what safe means. Safe from what? Inflation, banking risk, currency decline, market volatility, government policy, personal uncertainty. Each answer leads to a different strategy. If you are buying silver as insurance, you must think like someone buying insurance. You do not buy insurance because you expect excitement. You buy it because you understand fragility. You size it carefully. You hold it patiently. You do not panic every time the price moves. But if you buy silver as a short-term trade while telling yourself it is insurance, you have already confused your own mind. And confusion is expensive. The second warning is this: silver does not move according to one simple rule. Many people believe that if inflation rises, silver must rise. That sounds logical. It is also incomplete. Silver may respond to inflation, but not always directly, not always immediately, and not always in the way retail investors expect. If inflation rises and central banks raise interest rates aggressively, the US dollar may strengthen. A stronger dollar can pressure silver. If investors expect recession, industrial demand may weaken. If liquidity dries up, people may sell whatever they can sell, including precious metals, even if the long-term case remains intact. This is why silver can frustrate people. They may be right about the big picture and still suffer losses because they misunderstood the path. They may correctly see that fiat money is losing purchasing power, yet buy silver at a short-term emotional peak. They may understand debt but ignore liquidity. They may understand inflation but ignore the dollar. Silver does not exist in isolation. That is one of the most important lessons for anyone who wants to understand it. People look at a coin, a bar, or a chart, and they think they are studying silver. But what they are really studying is a mirror. Silver reflects the condition of the financial system around it. It reflects confidence in money. It reflects the strength or weakness of the dollar. It reflects central bank credibility, industrial demand, investor fear, and the availability of liquidity. To understand silver, you must first understand the system it is reacting to. The modern financial system is built on confidence. Most people never think about that because confidence is invisible when it is working. Your bank balance appears on a screen, your currency is accepted at the store, your retirement account shows numbers that seem stable, your government issues debt and investors buy it. Central banks speak, markets listen, and the public assumes that someone somewhere is in control. But confidence is not the same as control. Confidence is a belief. It can survive mistakes for a long time, but it cannot survive endless contradiction. If governments borrow too much, central banks print too much, currencies lose purchasing power, and institutions demand trust while repeatedly failing to earn it, confidence begins to weaken. Not all at once, not loudly. It weakens quietly in small decisions made by millions of people. Some buy gold, some buy silver, some move money outside banks, some reduce exposure to financial assets, some begin asking questions they never asked before. Silver tends to benefit when those questions become serious, but that does not mean silver rises in a clean, predictable line. The global financial system is not a simple machine. It is a network of competing pressures. One force can support silver while another force pressures it lower. Inflation may increase demand for hard assets, but rising interest rates may support the dollar. Geopolitical tension may create safe haven demand, but a liquidity crisis may force investors to sell assets indiscriminately. Industrial demand may rise, while recession fears may weaken commodity markets. This is why silver requires a broader lens. The first macro force to understand is the US dollar. Silver is priced globally in dollars. That means dollar strength or weakness can have a major effect on silver's price, even when nothing has changed about the metal itself. If the dollar strengthens, silver often becomes more expensive for buyers using other currencies, which can reduce demand or pressure the price. If the dollar weakens, silver may attract more interest as a hedge against currency decline. But even this relationship is not mechanical. Sometimes silver and the dollar move in unexpected ways because markets are anticipating policy shifts, liquidity stress, or geopolitical events. Retail investors often get trapped because they look at one factor and ignore the rest. They say the dollar is weakening, so silver must rise. Or they say inflation is high, so silver must rise. But markets do not obey single-factor logic. They move according to the interaction of many forces at once. The second macro force is central bank policy. Central banks influence interest rates, liquidity, inflation expectations, and risk appetite. When they expand money supply, they may weaken confidence in fiat currency over time, but when they raise rates, they may strengthen the currency in the short term. When they rescue markets, they may calm panic temporarily. But every rescue can also create moral hazard and deepen long-term fragility. This is the central contradiction of modern finance. The more central banks intervene to prevent crises, the more dependent the system becomes on intervention. Markets begin to assume rescue, investors take more risk, governments borrow more freely, asset prices become inflated, and over time the system becomes less stable, even though it may appear calm on the surface. The silver market has a structure most retail investors never see. They see the price on a screen, they see a chart moving up or down, they see headlines about inflation, mining supply, industrial demand, or currency weakness. But beneath that visible layer is a deeper market built on futures contracts, options, leverage, institutional flows, and liquidity conditions that can overwhelm the physical story in the short term. This is where many people become confused. They ask, if silver is scarce, why does the price fall? They ask, if demand is strong, why does silver not move higher? They ask, if fiat money is being debased, why does the metal not immediately reflect that reality? The answer is that price is not made only in the physical market. Price is often made in the paper market. Silver futures allow traders to control large amounts of silver exposure without holding physical metal. This creates flexibility, liquidity, and opportunity, but it also creates distortion. Paper claims can influence price far beyond the movement of actual bars and coins. A large futures position can pressure the market. A wave of selling can trigger stop-loss orders. Leverage can force liquidations. In the short term, the paper market can dominate the physical reality. That is not a conspiracy, it is market structure, and structure matters. The first warning in this area is that silver is a relatively small market compared to the amount of capital that can move through it. Because the market is smaller than stocks, bonds, currencies, or even gold, large players can have an outsized impact. A hedge fund, bank trading desk, or institutional commodity strategy can create price movement that looks mysterious to the average investor, but it is not mysterious to those who understand liquidity. Liquidity is the ability to buy or sell without dramatically moving the price. In calm markets, liquidity can appear abundant, but in stress, it can vanish. That is true across finance, but it is especially important in a market like silver. When many people try to buy at once, premiums can rise. When many people try to sell at once, bids can disappear or become unattractive. The price you see on a screen may not be the price you can actually get in the real world, especially with physical metal. This is why the idea of silver as safe must be handled carefully. Silver may be safer than fiat currency in one sense because it cannot be printed, but it may be less liquid than cash in another sense, especially during sudden volatility. It may preserve value over long periods but still create short-term stress for someone who needs immediate access to funds. The second warning is that institutions understand retail psychology. They know that many small investors buy during excitement and sell during fear. They know that round numbers matter psychologically. They know that headlines can create emotional waves. They know that social media can turn a market move into a crowd event. And when crowds enter markets emotionally, they become predictable. The crowd often buys after the easy move has already happened. The crowd often panics during normal corrections. The crowd often wants certainty at exactly the moment when uncertainty is the source of opportunity. Institutions do not need to control every price tick. They only need to understand behavior better than the people on the other side of the trade. The third warning is that narratives can be dangerous. A narrative may begin with truth. Fiat currencies are under pressure. Governments are over-indebted. Central banks have expanded balance sheets. Silver has industrial demand. Supply may be constrained. These are legitimate points. But when a legitimate point becomes a simplistic story, investors become vulnerable. They stop asking hard questions. They hear, "Silver is real money," and they forget to ask about timing. They hear, "Silver is undervalued," and they forget undervaluation can persist. They hear institutions are manipulating the price, and they use that belief to excuse every timing and risk management are not secondary details in silver. They are the difference between strategy and gambling. Many investors believe the main question is whether silver will rise over time, but that is not the only question, and for some people it is not even the most important one. A person can be right about the long-term direction and still lose money because the timing, position size, or emotional response was wrong. Markets do not reward people simply for having a thesis. They reward people who can survive the path. The first principle of timing is patience. Patience does not mean doing nothing forever. It means refusing to let fear choose the moment for you. When silver becomes popular, when everyone begins talking about it, when headlines become dramatic, when social media fills with certainty, the emotional pressure to act can become intense. That pressure is dangerous because it feels like clarity, but urgency is rarely wisdom. A disciplined investor does not buy because others are excited. He waits for alignment. He studies the dollar, interest rates, sentiment, liquidity, industrial demand, and price structure. He asks whether the current move is driven by durable forces or temporary emotion. He asks whether he is entering because the opportunity is attractive or because he is afraid of missing out. Fear of missing out is still fear, and fear is a poor foundation for financial decisions. The second principle is position sizing. No asset should dominate your financial life unless you are prepared to accept the emotional and financial consequences. Silver can play an important role in a portfolio, but overexposure can turn a hedge into a source of anxiety. When the position is too large, every price movement becomes personal. A normal correction feels like betrayal. A temporary decline feels like disaster. The investor stops thinking clearly and starts reacting. This is why serious investors size positions not only according to potential return, but according to emotional endurance. Can you hold silver through volatility without panic? Can you watch the price fall and still understand why you own it? Can you avoid selling simply because a short-term move makes you uncomfortable? If the answer is no, the position may be too large. The third principle is purpose. Before buying silver, define its role. If it is insurance, treat it as insurance. If it is a trade, treat it as a trade. If it is diversification, define how much diversification you need. If it is a hedge against currency decline, understand that currency decline may unfold slowly and unevenly. The danger comes when people change the purpose after the price moves. They buy as traders, then become long-term investors when the trade goes against them. They buy as insurance, then obsess over daily price movements. They buy for protection, then use leverage. They buy for calm, then behave with panic. A strategy that changes with emotion is not a strategy. The fourth principle is liquidity. Physical silver has advantages, but liquidity must be understood. Selling physical metal may involve spreads, dealer availability, premiums, verification, and timing. In calm conditions, this may not matter much. In stressed conditions, it can matter greatly. Paper silver products may be easier to trade, but they introduce other risks. There is no perfect form. There are only trade-offs. Understanding those trade-offs before you buy is part of preparation. The fifth principle is exit planning. Many people think carefully about buying and barely think about selling. That is a mistake. Every investment decision should include conditions under which you reduce, rebalance, hold, or exit. This does not mean you need to predict the future perfectly. It means you should not be forced to make your first serious decision in the middle of volatility. The time to create a plan is when you are calm. Once the market starts moving rapidly, your mind will search for emotional shortcuts. It will want relief. It will want certainty. It will want someone else to tell you. The deeper lesson about silver is not really about silver. It is about how people behave when trust begins to weaken. When confidence in paper money is strong, people rarely think about metals. They trust banks. They trust statements. They trust central banks. They trust that the future will resemble the recent past. They believe liquidity will always be available, that markets will always function, that governments will always find a way, and that the numbers on a screen represent security. But when trust starts to erode, people search for something outside the system. That is when silver re-enters the conversation. The danger is that by the time many people notice, they are no longer thinking clearly. They are reacting. They are trying to protect themselves quickly from risks they ignored slowly. They are not building resilience. They are trying to buy peace of mind. And peace of mind purchased in panic is often overpriced. This is why the most important move may be the one you do not make immediately. Not because silver is bad, not because silver has no role, but because hesitation, when used properly, is not weakness. It is analysis. It is the moment when you separate fear from strategy. It is the pause that allows you to ask, what do I actually believe? What do I actually know? And what am I actually prepared to hold? Most financial mistakes begin when people skip that pause. They hear a narrative and mistake it for understanding. They hear that silver is undervalued and mistake that for timing. They hear that the dollar is fragile and mistake that for an immediate trade. They hear that institutions manipulate markets and mistake that for permission to ignore risk. But serious investing is not built on slogans. It is built on clarity. Clarity about the asset. Clarity about the system. Clarity about the role of the position. Clarity about the risk. Clarity about your own emotions. Silver can be a hedge against monetary disorder, but it cannot hedge against poor judgment. It can sit outside the banking system, but it cannot protect you from buying too much, too late, for the wrong reason. It can preserve value across long periods, but it cannot guarantee comfort across every short-term price movement. The investor must bring discipline to the asset. The asset will not provide discipline by itself. This is where many people misunderstand hard assets. They assume that because a metal is ancient, tangible, and scarce, owning it automatically makes them prudent. But prudence is not in the metal. Prudence is in the decision-making process. Two people can buy the same silver at the same price, and one may be acting wisely while the other is acting recklessly. The difference is purpose. One person buys a measured allocation as part of a larger plan. He understands volatility. He knows the role silver plays. He is not expecting miracles. He is not using borrowed money. He is not trying to impress anyone. He is preparing quietly. The other person buys because he is frightened, impatient, and convinced that a dramatic move is imminent. He has no plan. He has no exit strategy. He has no understanding of the paper market, liquidity, or position size. He believes conviction is enough. The market will treat these two people very differently. The first may still experience volatility, but he is not ruled by it. The second may own the same asset, but he is still vulnerable. That is the key point. Silver is not the danger. Ignorance is the danger. Emotion is the danger. Overconfidence is the danger. Believing that ownership alone equals preparation is the danger. The financial system today is fragile in ways many people do not fully understand. Debt is high. Central banks are constrained. Governments are politically pressured.